Major banks just predicted the yen will collapse to 160 per dollar by end of 2026. And the Bank of Japan's latest rate hike actually made it worse. Here's why. JPMorgan, BNP Paribas, and other major banks predict the yen will weaken to 160 per dollar or beyond by end of 2026. The yen just hit an 11-month low in December, despite the Bank of Japan raising rates to 0.75%, the highest since 1995. Wait, how does raising rates make the currency weaker? Because the rate hike didn't matter. Japan's real interest rate is negative 2.15%. Inflation is 2.9%. The policy rate is 0.75%. That means holding yen actually loses you money. Meanwhile, US 10-year Treasury yields sit at 4.1%. Japan's 10-year bond yields 1.6%. That's a 2.5% gap. Capital is flowing out of Japan into US assets chasing higher returns. The Bank of Japan raised rates but gave no guidance on future hikes. Markets interpreted that as weakness. The yen dropped 0.8% immediately after Governor Ueda's press conference. Here's the structural problem. Japan needs aggressive rate hikes to support the yen, but inflation at 2.9% is manageable. The economy is weak. Aggressive hikes could trigger recession, so the BOJ is trapped. And with Trump tariffs threatening Japanese exports, fiscal stimulus likely coming, and persistent capital outflows, the yen has no support. Japan's finance minister warned against speculative trading and threatened bold action code for currency intervention. But intervention only works temporarily. History lesson. In 2022, Japan spent $60 billion intervening to support the yen. It worked for weeks. Then, the yen collapsed again. Until the interest rate gap closes, intervention is just burning money. The bottom line? The yen is structurally weak. And it's getting weaker. Hit like. Subscribe to Finance Untold. Drop a comment. Is the yen heading to one? Thanks for watching. Stay financially untold.